Great. And good morning, everybody. Good afternoon if you're on the East Coast, and good evening if you're calling in from Europe today. My name is Michael Filighera. I am the proprietor, analyst, trader with traders, helpingtraders.com, logicalsignals.com. And also I do have an additional channel, and it is eyeofthestormpodcast.com. And so what I do right now is that I am an analyst and I provide daily updates, and I call them the Elliott Wave update. And in that I cover the NASDAQ 100 and the S&P 500, both the futures markets. Once a week, I give a big picture update, again, via YouTube. And that then covers the cash markets in the SPX and the NDX, but also the treasuries, gold and silver, and the dollar. And the action has been wild and woolly and crazy, and the markets are attempting to figure themselves out. Where do they need to be? What do they need to do? And of course, most of that is going to be wrapped around what are we doing about inflation? What are we doing with the interest rates? What, et cetera, et cetera, et cetera. And it's providing a lot of trading opportunities. But I will start by saying, and again, nothing against what Anka said, but I am a day trader, and my specialty actually is scalping. And I have a lot of success scalping, but I understand Anka's point, and quite often it is going to turn into, there aren't many. So I would say that there's not a large number of people or traders that actually find continued success by scalping. And again, what has gone into that and made me a scalper is that I was an options market maker, and I did that for 35 years. And I was a member of the Pacific Exchange. I was a member of the London Traded Options Exchange, and I was a member of the European Options Exchange over in Europe for many, many years. And so you develop different styles simply because you're in a pit, or you can see the market and you can see who's coming into play, and et cetera, et cetera. So scalping became a tool that was more fun than anything else for me. When I stopped trading options and switched over to just trading the futures and becoming a day trader, I then honed more of my skill into actually scalping, because I felt that the markets that I chose to trade are the S&P 500 and the NASDAQ 100. The NASDAQ 100 is a beast. Just from the get-go, it is a beast. And the market will move quickly in one direction or the other, and then suddenly reverse and go back, and et cetera, et cetera. So I started to shrink my time frame of how I wanted to trade things. And then I focused more on price action, and then adding in some additional tools. I've always carried an Elliott Wave count. I learned Elliott Wave in 1989 and actually 1988. So I've been physically using it since 1989, and then analyzing it and publishing my analysis since 1990. So I've always trusted it. Elliott Wave is not something that is put together on fundamentals or on indicators or other things that are more technical. It is a technical indicator, but the wave principle itself is truly just measuring human emotional responses to the market and how people react at specific points. And what R.N. Elliott, who was the creator of all this, what he ended up doing was actually being able to chart the different moves. And what he then noticed was the repeating patterns, hence the beginning and the start of, excuse me. Yes, I will answer that question, Ashik, in just a moment. In that, what Elliott was noticing was that there was patterns, and there was patterns for what he calls an impulse move, and then there were patterns that would be the counter trend or the corrective waves that we count and that we do. And that then developed over the years. So, for example, in an impulse move, there's only one structure. and that is a 5-wave structure. So if I can open this up, I will try to show it to you. And it's going to come in right here because we're counting 5 waves up. So it's counting as 1, 2, 3, and there's the 4. We just put in the 4 today, and likely going to finish this by going higher and exceeding that high for a 5th wave. So you can see it's a 1, 2, 3, 4, 5. There's one pattern. What happens in between them was very difficult, very difficult. But the markets have been very difficult at the moment. Again, because there's a lot of information that's being filtered through that has to be filtered through. How is it going to affect it? We've had bank failures. We've had an ongoing concern about what other additional banks may or may not be on that precipice of failing. So we just have so much going on, plus geopolitical instance of fires burning all the way around the globe, plus our own economic problems that we're counting on the Fed to deal with, and that is inflation. And so the market tends to wrap itself around, well, we'll wait for that number, we'll wait for this confirmation, we'll wait for that confirmation. And in between, the reason that I became a day trader and then a scalper is because sitting and waiting for the market to make a decision, it's like, okay, well, we're now going to buy into this because we believe that we're going to move higher. Takes a while to be produced, and then again we'll see it. But in that, and in essence, this was a good trade if you went long, but the length of time that it's going to take for it to get up there is kind of based on a notion that the Fed was going to pivot. It's still based on the notion that the Fed has to pivot because we're having bank failures. So we tighten interest rates is going to push more banks to that brink of failing because of the bad positions that the bank has on. But I think it goes deeper than that. And I think that our understanding of actually what is happening behind the curtain, so to speak, is more important than what we're hearing on CNBC or Bloomberg or any of the market wires. Because that's just, we're discussing people's opinions about what they think the Fed should do against reality on what really they can do or not do. Because if we take a step behind the curtain, we're going to realize that the whole banking problem came about because the Fed held interest rates low for way too long. And then just as that pandemic low was being put into place, they lifted the deposit requirements. The banks had to have so much reserve against their total cash value of their deposits. They dropped that. So banks didn't have to have X amount of money in reserve. So what happens after that is like what happened with Silicon Valley is they actually went over, took the depositories' money and put it into the 10-year note. And probably at a very good rate at the time. So they secured 1.63. That was their rate. But the thought process was that interest rates weren't going to go up. Well, guess what they did? They went up, and they went up substantially. Thus, they did not hedge that position. So again, it's not the Fed's fault. They may have created the scenario, but it's up to the bank itself to hedge itself against risk for if interest rates were to go up, and they didn't. And so that produced the problems that they got into, that they tried to mask and they tried to get out of, they tried to pull in more money, et cetera, et cetera. So it was really just bad management and bad trading for Silicon Valley Bank. But the problem comes in is to, well, how big can this get? So that's really what I think the market is now grappling with, as well as what can or what will the Fed do? Are we going to believe that the chairman, who basically was asked, do you see a point where you're going to do QE versus QT? And he basically, not raise the rate. And he said, no, he didn't see that happening this year. And he said this in March. We still got 9 months. What do? They're taking the market higher. So again, it's to whether you're going to believe it or whether you're going to, what you're going to do. Now, add into this, folks, that we now have something that I've discussed in great detail in my own updates each day, and those are called 0 DTE options. And I'm putting it up right here. These options, they expire today. So they've been in play this week, but they've come into play today. So a lot of this movement, like you see all these options and how they're trading? These are very large players and just a lot of different traders who are coming in and they play these options because there's no risk overnight, because they don't exist at the end of they expire at the end of today's session. So there's a lot of risk removed, but then what happens is that if you have any understanding of options, within an option, you've got a bunch of Greeks, they call it. And what they are, and I'll just put those up, are delta, gamma, theta, vega. There's rho, which is interest rates, and there's another one called vana, which deals with volatility. So what's really happened underneath all of this, what makes the market go up and down, are some additional facts that are not being factored in and not even being considered because they don't really fit in the are you bullish or bearish separation. And when we're talking about volatility, of course, everybody's feeling that, well, with volatility as measured by the VIX, if the volatility is going down, well, then the market's going up. That's not always the case. There's time when the market could be dropping very heavily and volatility is going with it. It depends because there's so many sub-products attached to the volatility that creates the situation that forces the market to go in one direction or the other, that have no relationship, so to speak, with what the actual index is doing. It has to do with what the options are doing. The VIX was the volatility index on the how it started on the OEX options, which is a part then it was called the S&P 100, that got expanded to be included the S&P 500. So it's how those options are trading. Well, here is the S&P 500 options, excuse me, based on the S&P 500 future. We can go over to what I call the big daddy, and that is the SPX. So within the SPX, same deal. We have options that expire today. So what happens is that during the day, we're following and we're looking at where our open interest is, and we can start to see where they're likely going to pin today's close, today's expiration. And if I can do it in the SPX, basically right now, I just add $30 and I can get that level in the futures market, because there's approximately, but it's still about $30 difference between the cash and the future. Well, right now, it's sitting right at that point. If we come down here and we look at 4,100, boom, 65,000. So they're starting to play out a little bit to see, well, we've got a little bit of other room, but again, I don't know if they're buying, if they're selling. We can't tell that from the volume, but we can tell where they're likely going to try to pin the close today in the cash market. And right now it's 4,100. Now we still have plenty of time so they could play and they could move back and forth and all around. So what I'm actually bringing in and what I'm trying to say is that now as your day progresses, because we're looking at what's going to force the index higher or lower, we have other readings that we can pull in, and that's going to tell us how much gamma, positive or negative, is actually in play. So what the gamma reading does, folks, is that it tells you how much the delta is going to move for each dollar tick in the underlying. But if we come out to that 4,100, you can see it's got a pretty low gamma right now because it's trading right there. If it moves away from that market, the gamma is going to increase. So right now, they're all pretty happy. Where we have the gamma is in the put. That's huge. 0.47, that's huge. So where we're going to get the reading is if we have a negative gamma in this strike, it's likely going to be due to the put. And so what happens with a negative gamma? That's going to tell us that these guys are likely long this put. So if the market starts to drop, you're just going to get longer. So which is fine, but if the market goes up, you're going to have to adjust. And that's my point. And that's what then turns in and forces these big moves that we see. If we're looking at a chart and you're looking at, this is an hourly, but if I bring it down, even put it on a 5-minute chart, you get these moves. That's a lot of adjusting. That's a lot of moving in and making adjustments as the market goes up and repins itself. Because don't forget, we dropped down, we came up, they dropped it down again. And then what is happening here is we're getting a lot of larger algorithms that come in, and they're buying and selling, and they're just moving a lot of positions. And so when we put that all together, now I come up with my picture for intraday trading. And when you're getting a clear enough picture and you're a scalper, you're going to want to hold your trade. You're going to want to participate and let it carry out. When you're getting an idea that you already know that 4,100, which is going to equate to 4,130 in the future, if that's the target, well, play it. So one question that was asked was, I missed the wave count too, sorry. I will go through the way I count the waves, no problem. I want to go back to answer, if I don't mind telling why I switched from options to day trading futures. To be very honest with you, the reason I switched and decided I didn't really want to play in the options market anymore, I left the floor, as many market makers did, and then I transferred and I went to my own home office and I continued to trade. But to get the feel for what the market was doing and who was coming in and who was doing things, I lost by leaving the floor. So my information was shortened, was cut off. And so, because you went from being what was considered a professional trader to being a retail. And so it just became more difficult. And I didn't want to have overnight exposure that would get killed volatility wise, because we saw a lot of really fast moves that would happen real quick. And your volatility would just go nuts and your option pricing went nuts. And so you were either forced to take the loss or hedge or do things. And that became more of a burden. And so I decided, you know what, I'm just going to day trade futures. And then I want the volatility. I want those quick and solid moves because that was going to let me get in and get out, and I could still make my money and be happy. So that was the primary reason. Do I still trade options? Not as much. Now I'm more in tune with actually just trading the future. But I'll tell you, again, because of overnight risk, I don't carry positions overnight. That's the great thing about day trading. There's too many people that they want to be a swing trader, but they want to swing trade for 1 or 2 or 3 days. And so I think that's great. And sometimes it works, but it depends on your account size, on your trade plan, on how you put that together. You know, I advocate that as traders, if you're coming in to day trade a market, or even if you're going to swing trade or whatever your position is, as Anka also revealed, where's your stop? So what's your trigger? So I have 3 basic rules. I think everybody's rules can be very different. My basic rules are, what's the trigger? That's going to be my entry. And what is triggering it? Is it a moving average? Is it, that the futures are doing a pop and now they're coming in because I see a gamma reading or some other outside source of an indicator? Primarily for me, I'm using Fibonacci and moving averages, plus price action. And again, in that case, I'm really reading the price action on a 2-minute. Oops, maybe go show that 2-minute chart. So right now, 2-minute, I got a 1-hour chart on the NASDAQ because I was just looking at something. But even if you're using it on a 1-hour chart, right off at the open this morning, you got a buy signal. And you look what happened. If you just stayed long. So, but you'd have to, it depends on what what is your goal? If your goal is to capture the entire move and you want to trade on an hourly basis, you still can get a signal to get your position on, but your stop is likely going to be much bigger. So in other words, it's like, let's say you got in here at 13,030, we'll call it, we'll just even it out. Your stop has to be there at 12,980, actually. It has to break below that low before the reason that you were getting in would be invalidated. So again, starting over, I have a trigger and then I have a goal. So what am I looking to make on the trade? And then the third is, where is my stop? So where am I willing to exit this trade if and when the trade becomes invalidated? So if you're really a day trader and you're a scalper, those are going to be pretty tight. If you're more of a swing trader, you're going to have a lot more room. Now, so you're going to figure your risk as to what can your account actually handle. And so those are the big differences. So each time that if you were to come to me and say, well, I want a swing trade, I'm like, okay, well, you're going to set your trade up differently than I'm setting up my trade. Your goals on that trade are going to be much different than my goals. Your reasons for getting in are going to be different than my reasons because your time frame is totally different. So taking all that into consideration. Now, let me just start getting to a lot of what people are already asking me. I go slowly through the way I count the waves. Sure. Let me go back over here again. If I'm on a 5-minute chart, understand that in Elliott, the basic premise is you got 5 waves and then 3 waves and then 5 waves. And then, those are the basic patterns. Now, where they change up is that there's only one basic pattern for an impulse. And within a move like this, your impulse waves are 1, 3, and 5. Waves 2 and 4 are the corrective waves. Wave 2 corrects wave 1, wave 2 corrects wave 1, and wave 4 corrects wave 3. All very applicable. So how I would count it, I count 5 up, that's wave 1. ABC is wave 2. Then I start a third, which is going to subdivide. It's going to create its own 5 waves. There's 1, 2, and then we're breaking into a third, and that takes us all the way up to here. Here's wave 4 internally, right? Wave 4 of 3. Here's wave 5 of 3, completes that move. Here we get an ABC down, that's a wave 4. Now we're in a 5, which will also break into its own 5 on a 5-minute chart. So even if I open this up, you can see, okay, 1, 2, maybe that 3. I don't think it's over yet, but the market makers already realized, well, we're at 41.30. That's kind of where we're going to pin it. How much higher do we want to go? So then we're going to have to, if they're going to start pushing higher, you're going to force a lot of adjustments within the options world. You're going to force buying and selling. And maybe that's the game. I don't know. But you can play it simply by saying, well, I got a 1, a 2, I'm looking for a 3 and a 4 and a 5. And then I can add Fibonacci. If I'm looking for what this 5-minute, on this 5-minute chart, what possibly could this 5th wave do, I'm going to come right down here and I'm going to put up my fibs. Now, again, when you study Elliott, you're going to get an idea because it's all been worked out for you. What are the most common retracements or levels that can be associated with a 5th wave? Now, the relationship is that a 5th wave is related to its closest neighbor, and that would be the 3rd wave. So on a Fibonacci basis, what are the most common levels? The first being that the 5th wave will come in at 0.618 times the length of the 3rd wave. That's right there, 41.43. So I'm already signaling, well, if this thing goes, that's where it can go. What will take precedence over that is structure. So basically the 5th wave just needs to take out that high. We've already done that. Barely, but we've already done it. So maybe this is a 1, 2, 3. We're putting in a small 4, and then we'll get a 5. Can it still get up there? Technically, yes. Realistically, maybe not. So again, you give yourself your own edge on. So, and then if I'm trading this, You can bring it down even to a smaller time frame, but say I got long here, or I got long here. Well, I got long at 41.28, is trading at 31. You got about maybe 3.5 points in there. That's pretty good. I want to start protecting that. I hate giving back money. In a market like this, you hate giving back money. If you don't need to, why do it? We all have our goals each day, and that is, of course, to be successful at trading, to accrue profit. So again, you need to put into your own system ways in which you can do that and ways that you can protect that. And again, I'm going to just reference Anka, who came before me, and I was watching and she was talking about her trade. I think it was UNH or whatever, what the market was. And she was telling you that, see, I would have moved all my stops up to that level. Why? Because the market you need to protect. Because if you're getting up to a level where it could turn, you better protect. You still want to give it the benefit of the doubt that it may break to a new high. But if it doesn't, I want to be out. So I give them the market the benefit of the doubt, but I level where it's like, I'm taking my profit there. So that's the goal. The goal is to be the winner in the trade and not to hang out for an extra dollar or two and then watch the market reverse on you. Okay, so let's just kind of, okay, Frank, you kind of got to stop with that kind of talk. That's not acceptable. The platform that I actually use for trading is NinjaTrader. So that NinjaTrader, yeah, I could show you that I'd have. Let me just see. I'll go over here. Oh, no, go one more. Here's NinjaTrader. Oh, and that didn't go. Let me go over and just redo my screens, and then you're going to see NinjaTrader. And there you go. Here's NinjaTrader. So here's my S&P so far today, and here is my NASDAQ because I got a late start and starting to trade it, and so that's what I'll do. And so I use NinjaTrader, but again, within NinjaTrader, you can see what I have is an order flow profile, and that's all of these different lines. That's the point of control, value area high and low, which I do expect to shift higher. The magenta lines above and below are the range today. And what a range when you really think about it. 12,953 in the bottom, 13,161 on the top. Nice day. Nice trading. Took a while for it to engage, but boy, when it did, it was pretty powerful. So back over to here. And so we should still be, yes. So it didn't go clicking out. Back over to questions. Okay, that one, and then, okay, wait, you're welcome. Because someone previously was asking on Bitcoins. I actually do not trade Bitcoin. I don't chart Bitcoin. And so I would not be able to comment on that. But if I'm reading it saying the daily Bitcoin chart is really interesting in a consolidating pattern for 3 weeks. In these 3 weeks, looks like a triangle pattern with higher lows and lower highs. Okay, I use the daily chart on FinViz. Which direction do you think it will break out? Counting a triangle. All right, let's just, I'll tell you what, I will just go over and take a quick look for you. I'm going to trust that you're using the Bitcoin future. And that's on a 5-minute, which isn't going to do us any favors. Go to the weekly, I think you said. To me, that is not. I actually did used to, you can tell. And that would be a 3 there, and it just pulled into working its way into 5 down. And so it's not a 4. If it is, it's a much larger 4. And what the market is telling me on a weekly chart is that's A of 4, B of 4, which it isn't, because you see it's 5 waves up. So again, I'd have to count this as an ABC. A, B, tough call, but you can work it out and bring it down and put a 4 there. 1, 2, 3, 4, 5, one of the next wave up. So again, it still looks, I don't see the triangle pattern that you are referring to. Maybe you can be more specific. This particular is the toss, the Thinkorswim platform. Oh yeah, there you saw it. Okay. So let me go back up here on the daily chart. Okay, well, let me take this down and let's look at it on the daily and see if we can see that triangle pattern. It's still, so you have to be able to actually draw the triangle. And that way you're going to be, triangles are counted A, B, C, D, E, and they wedge. And if they're diagonal, then they're wedging up, but they still wedge. And so you have a declining and then you have an ascending or descending triangle, which is where the highs are lower and the lows are basically flat. And you have ascending, which is where the highs, higher high, as it works its way up. And usually what will happen is you're going to count it out, and all of the internal waves, all are ABC waves. So they're 3. So the A wave's 3, the B wave's 3, the C wave's 3, the D wave's 3, the E wave's 3. And how they form, you're basically you can use Fibonacci, where wave B would be between 3A2 and 618 of wave A. Wave C would be 3A2 to 618 of wave B, etc. So you can see how it begins to wedge itself, higher high, lower low, or higher high, or higher highs, and it just works its way lower. It's wedging. And so when you get to the bottom of an E wave, you're looking for it to thrust out of the triangle. And that's going to give you your keys to what direction. So, wherever your E wave ends, if it thrusts out, is it going to thrust higher out of the triangle, or is it going to thrust lower? If it's ending at the bottom side of a triangle, it's going to thrust higher. If it's ending at the top side of a triangle, it's going to thrust lower. And the general rule or the guideline there is that once a triangle is finished, the market will thrust out of the triangle. And usually that thrust is going to be the width of the triangle at that moment. So that's how I use that. So I don't necessarily see that in what you're showing me here. And so I would not be able to comment on any triangle patterns in Bitcoin because I don't see them. And so let me see what else we got. Well, then I'll show you, because we just kind of had one in the S&P. So let me go back over to the ES. Actually, it was in both the ES and the cash. And see, I get all my fibs off of this thing for you so we can actually see the chart. Let me go down here and get rid of. Oh, I had a lot, didn't I? Sometimes I get them all caught up in there. So initially, I had put this A was over here, and we were in a primary B wave. We still are in a primary B wave, but I ran the possibility that it was going to end up being a triangle. So here was my upper channel line, and then my lower channel line, and I'll show it to you so then you're going to see how we start to identify. I'm going to connect. So this would, so instead of this labeling, this would have been wave A, B, excuse me. Yeah, B, C, D, and then we get an E. So, but it's not right. So this is going to be A, B, C, D, and this should have been the E. Again, and now I can't even see the triangle, but you can see we get the pattern going. And I did have it counted out, and this was wave D, and this was going to be wave E. So if this is D, that's C, and this would be the B. And I could take this back and not call it that, but just do it internally, and it still would work. Because if I were to say A, B, C, D, and we get an E, the same thing should happen. It should trigger and go lower. So I can use that triangle pattern. I'm not counting it as such, because of the nature of the rally. But notice that the rally has stalled out several times. So I've not eliminated the count, but I've kept it in what I call an alternate part. So again, just to kind of put that into context, this is how you would recognize it. You see how they're all forming threes, 3, 3, 3, 3. So if this can get up and break that high that turns, it still does not change that to, it could be an ABC, but I'd be looking for it to throw over there. And the result should be it thrusts out of the triangle. And what does that suggest? Well, if that's the top range of the triangle, here's the bottom range. And currently, I'd be looking for it to break 38.85 and do it very quickly. So thrust means move. It's just going to go. And in this particular case, what likely is going to do or create it, what the catalyst might be, is anything out of the news. Currently, we have so many fires burning in a lot of different places that could really throw a wrench or stick into the spokes of the market and turn things super negative or super positive. So again, depending on the direction, this case, it would be down, and it always was. And that's if I leave this here, that this is the primary wave A, and this all is going to be primary wave B. So again, this would have to move to here. This would move to there. This would turn into a C. This would turn into a D. And here we have the E wave. So it's really not out of the woods yet in terms of is the triangle going to work or not. And that's in the S&P. The NASDAQ, on the other hand, which normally my counts in the NASDAQ and the S&P go hand in hand, is totally different. So the NASDAQ has gone, even if I were to put a triangle pattern together, it's exceeded it by far, way over. The throwover is way over, and it did not collapse. Yep, it came down, but it's coming down in what is, I'm going to label this as a 4. So in the NASDAQ, it does appear that we got an intermediate A and an intermediate B, and we're looking at an intermediate C wave. And then what I can add to this to give me some upside is, what are the potential? What's the potential for this C wave? Well, I go back to there. So that's where the A wave started. I go to the top of the A wave and I bring it down to the bottom of the B wave. And now I have my numbers, or my possibilities, what is this wave capable of doing? Well, we can see by opening it up, it came right up to a level where this wave, this C wave, would have been 100, whoops, got to bring it back down, 100% of that. Doesn't look like it because this took a lot more time. But in terms of price, it's now equaled it right there at the high, stopped. It stopped right on the nose and started to pull back. So there was the potential that, okay, this whole wave pattern is done. Have to shift the 3 and put the 4, and then this is the 5. But again, we came down, we held support for 4th wave, and now we're heading higher again. So it's your count has to be fluid and flexible. Otherwise, you're just going to drive yourself crazy. So I've always advocated to people studying Elliott that they actually always work with a preferred count and at least 1 or 2 alternates. The market is the market. And it's not like we're trying to put in what we're seeing. It's like we're putting in for, hold on a second. Yeah, there you go. We're putting it in, we're putting together a picture that is fluid. It's moving, it's changing each day. And so within my counts, I'm also putting up levels that where would the count become invalidated? So you know how I talked about where your stop is, where the trade becomes invalidated because you've shrunk it down to a very small time frame. Well, I'm looking at a daily chart. Where does this count become invalidated on an Elliott basis? Unfortunately, there's a 4th wave, it would have to come all the way down here. I would consider it at a much higher level. But still, you have to have a point where it'll shift to that alternate count. and then maybe shift again to another alternate count. And so that can be very frustrating to somebody who's not truly understanding how Elliott works in conjunction. It's still a great tool. It's still giving me a lot of the potential, even counting this wave, of how high it could get, because I can start to build what I call clusters of resistance by getting off of the daily. Now I'm looking for that fifth wave. If I bring it all the way down to the hourly, well, what was this? In the irregular 4, which is a whole different pattern to discuss. That's where we got the new high, but then it came up in 3. Well, then we're going to go down in 5, and then it's going to be considered an ABC irregular, but the 4 still goes there. And it held. Then we get this big rally. It's like, well, now I'm getting some confirmation just from what we're doing today that that was the 4, and we're likely going to start to break, but we're now going to get my next clues, right? See, this, I call this a similar, like this is a little bit of a black hole. Where's my resistance? Well, we don't really pick it up until 13,256 and then 13,311, which is that just below that previous high. So again, you can put together your picture, but remember, it's fluid. The market's moving every day. This morning we were down heavy. They were hitting everything. Now we're up heavy. And part of it is because we've got an expiration at the end of the day today. We've got a lot of options that are in play. We've got where they're going to pin it. And it has nothing to do whether they're being bullish or bearish for the weekend. It really does not. In fact, most of this had nothing to do with, gee, we're bullish on the market. Nothing. It had everything to do with options and 0 days to expiration options and how they trade and where they were willing to pin it. And if you can get a grip on where that is, you're gonna have a lot of levels in your trading that are going to be to your benefit. So, in any case, it does not. Elliott, the 88.6 fib, I've never heard of. Doesn't mean that it doesn't exist, but Fibonacci, that number sequence actually coincides with nature. The best way I can tell you. If you ever read Elliott's The Law of Nature, because we're human beings, we're a part of nature. We are constructed in Fibonacci sequences. So when you sit down and you look at, like, the Fibonacci sequence starts at the number 0, and then you take that and the next number, and then you take the next one, you add them together. So 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 1 is 3, and then you start going. So it's 1, 1, 1, 3, 5, and you just go up 8, 13, 21, 34, 55, and it goes on to infinity. Now, where the Fibonacci relationships come in, what is the difference between 5 and 8? 0.618, approximately. What is the difference between 8 and 13? 0.618. So he started to apply those relationships to moves in the market. So, yeah, thank you, because it just keeps going. It just keeps going to how that goes in. So kind of the way harmonics do, but I don't get the 88.6. I know a lot of people use harmonics now. And then people are even actually saying harmonic Elliott wave. Like, it's something that I've just never spent a lot of time. I hate to say it, but I am more of a purist when it comes to Elliott. And because to my benefit, I have received copies of, and of course there's Xerox copies or just, photocopies of Elliott's originally typewritten principle. So it's his original works, and he was putting his thoughts down. And that's where I go back to when I get stuck. What did he say? And there were many parts that don't come in from there. So when I get that somebody else is calling it harmonic Elliott, it's like, well, it's kind of, but then it's not Elliott. Yeah, you're right, Frank. Then come extensions. You're absolutely right. And if you don't understand how to include them in your analysis, then you can get yourself in trouble. So when I am doing my Elliott wave and when I am presenting it on a daily basis, I always attempt to give both sides of the picture. Here's what happens if the market's going to break higher. These are the levels. These are what to expect. If the market's going to break lower, this is what it should do. If it breaks this level, I'll look for this acceleration, or then I'm looking for this. So again, what I'm trying to present each day is just in a technical picture, both the preferred and the alternate counts. Right. And I have had discussions with Robert Prechter. It's like, why are you coming up with the W and the M? Let's call it what it really is. A WXYZ pattern is a double ABC. That I can understand, but WXYZ, I don't, but I don't understand why he differentiates. But if it works for you, that's what's more important. If you understand it and you're able to apply it properly, with all the guidelines and the rules associated with it, you'll make money. You'll make money on it. So yeah. Let's see. I'm just going back on if there's any, because I got a few more minutes here, and I know I spend a lot of time on this. Again, my primaries are the NASDAQ and the S&P. I also, let me just tell you, because there's one that is actually going, and it is spectacular. I've been a gold bud since the 1980s, everybody. And so I started applying Elliott to the gold markets many years ago. And it is a market that does follow Elliott pretty cleanly. And I picked it back up again to actually publish. And you can see it's like, this is on the 4-hour chart. We're doing a 5 waves up. And so we get the 1 and the 2, and now we got a 1, and this is a very sloppy type of a correction. So we start to run into a little bit of a few hiccups. Like, what are we telling me, gold? And then suddenly it'll do that. Where it broke out of the range that it had been in and soared. So is this a diagonal? Possibly. And that was the break up and out? Possibly, but I don't think so. So I'd have to consider that it's wave additional, another one too. Because if I'm in the third, right? If I'm in a third wave going up, third waves are normally the longest and the strongest out of a 5-wave sequence, out of waves 1, 3, and 5. The rule is that wave 3 can never be the shortest wave out of waves 1, 3, and 5. So if you just follow the rules and you keep those in mind, you can build your picture. And what we're looking for is if I'm looking for 5 waves up and I count them correctly, I'll always have my steps of where we go next. Then I can start projecting, right? Because right now I'm projecting for where can this whole third wave take us? Those are going to be these numbers. And here again, on this one, where can this internal third wave take us? So the internal one, minimum, I'd be looking for 2138. The larger third wave, if it's going to be the longest and the strongest over that first wave, it should be coming in up here. And that level is 2386. Have we ever seen these levels before? No. The high so far, the all-time high for gold is 2089. Now, what's behind this, people ask? Well, again, I follow gold pretty closely. So what's behind it is the central banks of our world are buying gold. And they didn't for quite a long time. And when we went off the gold standard, way back in 1973, there was no reason to back your currency with gold because we called them fiat currencies. They were backed by the good faith and credit of the country that's issuing the currency. Well, when that started to run into problems and we started having all these fluctuations, and then we had an introduction of the euro, et cetera, it really just kind of came off the rails in terms of, well, how should we apply this to gold? And so now what we're moving into, and I'm sure many of you already know, is that we are going to digitalize currencies. On the forefront of that right now is China. China has already in use a digitalized yuan. Now, if you consider it's digitalized, what's the closest thing we have to a digitalized currency? Bitcoin, all of the cryptocurrencies. Well, what's backing those cryptocurrencies? Nothing. They're virtual. You get nothing. You don't even get the coin. You just get virtual, and you have a virtual wallet, and you have virtual gains and virtual losses. It's kind of weird, but you're putting in real dollars. So what happens when the dollar loses value? What happens when the dollar gains in value? So when we're talking about right now, the United States, the US dollar continues to be the world reserve currency. Why? Because number one, gold trades in dollars, oil, the biggest one, trades in dollars. If you want to trade with the United States, you've got to come in with dollars. Well, our number one competitor to take that distinction away from the United States is China. So they're coming up with a digital yuan. They want to do business with that digital yuan. And they have started doing that. But now I think they realize you want somebody from the outside to say, okay, China, we are going to buy all of this product from China, and we need to pay you in yuan. What's it guaranteed by? Or China's buying something from the US or another country, and they're going to have to send us yuan. Again, what value does that yuan have if it's not being backed by the good faith and credit of the People's Republic of China? So you back it with gold, just like the good old days. You back your currency with gold. So if somebody showed up at the window and got, I got all these yuan, I'll take my equivalent in gold, please. They would have to do that. So I think that what we're seeing from the central banks is they're getting ready to start to trade in digital currencies. And large economies, large countries, they're going to want a little bit of security about taking those coins, taking whatever that currency is. So that's what I think is partially what's behind it. The other thing is that gold traders, now, this is something that you need to, they may not like interest rates going up, and that part is true. You'll see these big corrections in gold. But right now, if the dollar starts to sink sufficient or strongly enough, gold will rally. And that's actually what caused it the other day when we got that big break and it just ran. The dollar got hit pretty hard. A lower dollar is good for the price of gold. So the currency right now, if we just take a look at the dollar chart, the dollar chart does kind of show that we could drop below 100 on this index. And if we do, it may gap down there and just hold, because I'm thinking that what we have is an ABC, and this is the B section of this larger ABC rally, which will come in an A, a B, and then we get the C wave. And if that is what's going to play out, the dollar is basing, the dollar is bottoming, and is likely going to rally. And where's it going to end up? Back up here. What can produce that? A whole myriad of things, people. To try to pin something on what could cause it, sometimes it just does it. So we could expect to see that if it breaks below, then we're likely going to be into the next section, which would be a very large C wave, right? If that's the A wave, I'm looking for a C wave of equal size. And if that begins here, then we're looking for something that's really going to bring us back down pretty low. So something to watch. And if the dollar starts to collapse, you'll see the price of gold start to rally. Now, any questions? Because I've already pretty much almost used my allotment of time. Example of my DTE trade for today. It's actually not my trade. It is a trade. It's where the market, I believe. So I'm going to go over here to the products. Let's go back to the SPX. SPX, continue, look at that. Before it was sitting at 4,100. It's still sitting at 4,100. First thing I'm going to do, I'm not going to look at it that basis. I need to see what the volume in the open interest is. And you come down and go like, okay, the most volume right now is happening in this strike, move it over 4,100. So then again, I go over and I'll be looking at the put as well. If the market were to turn and drop, and it would have to do that in the next 2 hours, where are they kind of looking at? Right now, we got 40.80, very possible. 40.60, 40.70, it could. We've seen that type of volatility. We've seen with the index, the ES, the future, can jump $30 to $40 in 10 to 15 minutes. And that's going to come on what we're seeing as we're getting up to the expiration of these options. And the gamma comes into play on this strike. So you'll see it in the puts if you know who's long or short that put, as it moves towards the strike and below the strike, it forces the adjustment within these puts. If you're short these puts, you will get longer as the market drops. So what's your hedge? What do you have to adjust? You have to sell. So we get a turn in the market and then it starts going lower and these puts kick in. So you're looking and you're listening to someone tell you about what the gamma is, you know, what the gamma readings are, and it's a negative, it's going to be picking it up off of this. Now, remember, I went over before and I gave you, and we took a look at the delta gamma theta. Look at the gamma, right? These are huge. So as the market moves, say the market continues to move up, then what happens there? The gamma turns positive. Or we see these puts really start to get killed. And so what do they need to do? They need to buy, right? They need to make their adjustment to the other direction. So again, it's complicated, but not if you can just understand that's a big number. The volatility, don't forget, these options are priced to that number. And this is a 4,100 call. So what it suggests to you is that you can buy one SPX, or this gets settled in cash. So these are 6 bid at 610. In 2 hours, they expire. What's the intrinsic value? $1.90 at $1.80 at $1.90. Right? 4,100 minus that. So that's all premium. It's a whole different game in the options world. I don't think we have enough time to really go into that. It's just the interest. That is, how do you figure it's 30 points? It's approximately 30 points right now because of the interest between now and June that you would pay to be, you know, on that type of a position. That's where that comes from. Has that figure changed over time? Oh yeah, it will. Of course, you're paying less interest. So they become closer in terms of equal.